The stock market is currently following the exact same path of a bull market cycle template. And if you stick around to the end of the video, you're going to see that this template is going to help us to pinpoint exactly when this bull market will be coming to an end. So this video is really going to show you a little bit of the magic behind investor psychology, which is something that has been around for hundreds of years. And just to prove my point, this is the chart of the famous Tulip Mania, where the prices of tulips went up from under 10 currency units to around 200 currency units in just 3 years. This is investor psychology at its finest. The tulips are not a store of value. They do not have profits. They do not have dividends. There was no real fundamental reasoning behind this rally. And this kind of price behavior is something we have seen across asset classes since the birth of the financial markets. So this is the typical bull market template, not just for the stock market, but for any asset class. And we're going to see how this template fits into different bubbles in recent history, including the stock market bubble that we have now in 2020. So we start off with the accumulation phase, where the smart money sees a long-term opportunity and you start to get a nice trend going. You then have the first shakeout at the very beginning, shaking out weak investors. You then start to hit all-time highs again and start to build up a little bit more momentum. The media starts to come in and raise a little bit of awareness around the bull market. You then have the bear trap, which is often due to concerns over an overvaluation. And then you have the last phase, the euphoria, the delusion up to the top. And this is usually the phase where you can spot a bubble, where prices are disconnecting from the actual fundamentals. And you start to hear things like, this is a new era of investing. This time is different. And the infamous quote, make sure to like the video if you want to see more content like this. So one thing you do need to keep in mind is that not all bull markets end in a bubble. So let's apply this template to a few examples of financial bubbles and then apply it to the bull market of 2020. So we're going to start off with the dotcom bubble by looking at the Nasdaq 100 index. And throughout the video, I am going to leave the template over here on the top left so you can follow along as I describe. So to really look at the Nasdaq 100 in detail, we need to put it in log scaling, because that puts all the percentage moves in equal proportion, which is incredibly important when you have these kinds of bubbles. So we can say the real bull market started in the 80s back here. So this is the full bull market of the dot-com bubble. And you can see we have the initial accumulation phase in the initial years. We have two major shakeouts of weekends in 1987 and 1990. And then the move started to really build a lot of momentum. In the beginning of the 90s, this is when the media started to talk about the tech stocks. So far, the template is accurate. We're then looking at the bear trap. So we're going to zoom in here and you're going to see this move right here. This does not look like a huge move down, but from top to the bottom, this was an almost 30% drop down. So investors that were concerned over the overvaluation of tech stocks at the time, which was definitely the case in 1998, well, those investors sold their position into that move down. But of course, it's not over yet. We need the final stage of the bull market, and that is the delusion. And from the bottom of that correction in 1998 all the way to the top, the value of tech stocks went up 360% in just under 2 years. That is delusional. That is absolutely crazy. Of course, the bubble did pop after that, and from the top all the way to the bottom, it went down 83%, which is a percentage number that you will typically see after a bubble has burst. And so if we quickly look at individual stocks within the Nasdaq 100 at the time, we have stocks like Cisco, which from the 1998 crash all the way to the top went up 730%. We have Intel, which went up a staggering 350% as well during that delusion phase. We have Qualcomm, which went up from the 1998 crash all the way to the top, a massive 4,000%. And keep in mind, these were companies with big market caps. So you can absolutely compare them to companies like Apple, like Amazon, like Facebook, and even Tesla now. And remember this 90-degree angle on the chart. This is not normal price action. And in fact, 20 years later, if we zoom out all the way to 2020, these stocks have barely gotten above the dot-com bubble high. Now, another famous bubble that we can look at is the silver bubble. This bull market started in 2001 right here. We have the accumulation phase, the first sell-off in 2004, a very steep sell-off. We then have the momentum build with the media starting to raise awareness. We have the bear trap during 2007, 2008, and then we have the famous delusion. We can also look at crude oil. Crude oil had a bull market that started in 1998. Right here, we have the smart money coming in, the first shakeout, but still making a higher low. We then have the momentum phase with the media stepping in, one last shakeout before the delusion, and then the delusion. And again, if we measure out the delusion phase from the bottom in 2007 all the way to the top, that is a 200% rise in the price of crude oil. That is absolutely massive. So you're starting to get the point that this template represents investor psychology pretty well. So let's take a look at the bull market that we have now in 2020. So this is the S&P 500. So it's a great way of seeing the broad market. And again, we have the same template. Accumulation right here. Smart money gets in at the bottom when the stock market is undervalued here in 2009. You have the initial shakeout right here. This is when you had news headlines talking about a double dip recession everywhere in 2010 and 2011. You then have the momentum phase right here. We broke out to all-time highs, news headlines everywhere, and then you have the big bear trap right here. PE ratios were already getting very high here, so there was a lot of worry in the market. But of course, there's one more phase. The delusion phase. So what is going to be driving this delusion phase? With the dot-com bubble, it was the unprecedented innovation from tech stocks. With Bitcoin, it was a new paradigm of monetary exchange. With silver, it was the end of the currency system as we know it. So what is the delusion now? The Fed will never let the markets go down. Valuations in stocks do not matter anymore because the Fed is always going to be there at every small drop. Of course, this is delusion. The Fed cannot stop the markets from going down during a depression. But what they can do is influence investor psychology, which is exactly what they're doing and exactly what is feeding this bubble. And so far, there are two things that have interfered in the delusion phase. The first one being the monetary tightening in 2018, where the Fed decided to stop saving the markets until they did. And of course, the global health crisis. And since March 2020, the Federal Reserve has made it clear that they will support the markets no matter what. There is little chance that this delusion phase of the bull market will be stopped by anything other than the Federal Reserve itself or a massive blow off top in stock valuations. And if you've been watching stocks, you'll know that this delusion phase has already begun in certain sectors. We've got stocks like Apple that are going absolutely parabolic. The stock went up from $150 right here in 2019, and we're sitting at $500 right now. We have Amazon that's forming a 90-degree angle, very similar to what we had with the tech stocks in the dot-com bubble. And of course, we have Tesla also forming a 90-degree angle. So this is delusion. This is not normal. No matter how good you think a stock is, this is not normal price action. This is mania. But we do expect it to continue, at least for a while. Remember, this is not a tech bubble. This is a Federal Reserve bubble. So when we start to see broad rallies that include multiple sectors, that's when the markets will really go parabolic. That's when you're going to see the S&P 500 go up to 4,000 points in very short order. So how long is this going to go, and when is it going to stop? And there is a clear and concise answer to that. If we go back to the template, during the euphoria phase, most investors are bullish. A bubble will try to trap the maximum amount of investors at the top. And we can check this out on a sentiment indicator chart to see what the sentiment was at the top of the Nasdaq bubble. And you can see we have two lines, an orange line and a green line. The orange one is the bullish sentiment, and the green line is the bearish sentiment. And you can see right here is the top of the bullish sentiment, January 6th. And if we go to the Nasdaq 100 on January 6th, it is right here. So anyone who went against this extreme reading and placed a long-term short on the market on January 6th, right here, would have made a tremendous amount of profit. So what does our sentiment look like right now? In 2020, you can see right here, this is August 20th, 2020, and you can see the orange line was below the green one. We are on a very bearish sentiment. And so as long as the sentiment remains bearish, it's unlikely that we've topped. Now, we might not see an extreme bullish sentiment, but when it does start to pick back up and you start to hear things like, this is a brand new era of Fed intervention, they will never let the stock market drop. Well, that's when the stock market will drop. And before finishing the video, we would like to thank our sponsor, PrimeXBT, for this video. We think PrimeXBT is the best Bitcoin platform for margin trading. You can trade the S&P 500, other stock indices, Forex, cryptos. PrimeXBT lets you trade with up to 100 times leverage on stock indices and cryptos, so giving a relatively small position size a huge potential. Of course, you should know that trading is risky and that taking on leverage works both ways. PrimeXBT was able to sustain the volatility of the flash crash in March, which is rare for a trading platform offering that kind of leverage. Now, as always, good luck on your trading and see you next time.